Hello, my name is Ian McMillan, CMT. I'm a co-portfolio manager with Adaptiv, and today I'd like to talk to you about all the extremes we've seen throughout 2020, whether it's been equities, the fixed income space, commodities, sentiment indicators, lots of crazy, wonky behavior. Um, in fact, a lot of it, some of it I'd even forgotten about, and reviewing it just really makes it stand out more. Things that have never happened before in the market, really popping up all over the place, and quite the year indeed. So let's get into it. Without a doubt, I think the one thing that everyone will take away from this year, whether you are young, old, no matter how much experience you've had in the markets, no one had ever seen anything quite like what we saw during March. Certainly something for the history books. And in fact, as we know, it was the quickest drawdown of 30% or greater than we'd ever seen in the S&P 500. In fact, it was down 35% in 33 days. We also saw a record number of daily swings of at least 4%. That's up or down 4% in the S&P 500. The most days like that since the World War II. And we also saw 7 straight days of at least a 4% move, as you can see in this chart right here. 4% or 7 straight days of at least 4% up or down. That topped the record of 6 days last set in 1929. We know that the S&P got hit hard, but of the 4 major U.S. indices, the Russell 2000 was hit the worst, down 44% over the same time frame. And as we know, the Russell 2000 being more value oriented is heavily weighted towards financials and energy compared to its U.S. index peers. And no surprise that energy, by far the worst sector during the March drawdown, has been the worst sector for years, down nearly 60%, almost 25% more than the S&P 500 itself, and almost 15% more than the Russell 2000. We actually tied the record for longest streak during this drawdown with no back-to-back green days. That was at 28 straight trading sessions with no back-to-back green days. Pretty remarkable. And another interesting stat is that between March 9th and March 18th, the Dow Jones Industrial Average gained or lost between 1,000 and 3,000 points. So 8 times in March, the Dow had moved at least 1,000 points. And that's actually only happened 19 times on record. So I know using Dow points is kind of an iffy way to go about that. As participants, we really want to look at percent changes, but nonetheless, 8 1,000 point down moves, almost half of all of those recorded throughout history. So again, pretty crazy times in March. And as we know, with all those statistics, everything we know about 2020, there's been lots and lots of volatility. Volatility has been the theme of the party so far this year. Using the most common measure of volatility, the VIX, Volatility Index, put out by the CBOE, actually reached its highest peak, had an intraday high of 85.47, which eclipsed the previous records set during the Great Financial Crisis. So clearly, lots and lots of craziness, up near 85 you're essentially, if we're using the rule of 16, which is just a general rule of thumb, so the market pricing in 5% swings, daily swings, which is what we had. Lots of craziness when looking at that measure. Another visual that I think displays some of the wild volatility that we saw in March is this look at the first 3 months of the year. So January, February, pretty normal. You know, you've got some maybe a few 1% up days, a couple 1.5% down days. Pretty normal what you would see in a climbing market. And then we get to the end of February and into March, and things get really crazy. You know, almost two 10% down days, see a 9% up day, a 5 and a 6% up day, a 5 and a 7% down day. There's another 5. So the complete opposite of what we had seen the previous few months. I think an interesting way to think about this is that if we think about a cumulative absolute percentage. So for example, let's say that the Dow Jones returned over a 3-day span, it returned +1, -1, and -2. So overall, we're looking at 4 total percent, a move of 4 total percent, 1 + 2 + 1. And that would be one way to look at it. So if we want to take those measures, a 1 + 2 + 1 gets us 4. Then the absolute percentage change during March 2020 for the Dow was 117%, 117 cumulative absolute percentage change. And that's with only 22 trading days. So the average daily move was 5.3%. 5.3% if we're using that type of measure. The next highest month on record, which was October 28th, only October 2008, only had an average absolute daily change of 3.8%. So over 1.5% more per day than where we were at really near the depths of the great financial crisis. Interestingly enough, kind of using that same data point, since 1915, the average cumulative percent change for a month is 15.6%. And since March 2020 had an absolute cumulative change of 117%, we can kind of say that in a roundabout way that March had the total market movements for an average the average 8 months. So that 8 months of volatility stuffed into just 22 trading days, a pretty interesting way to look at the wild swings we saw in March. If we're going to talk about the drawdown, then we need to talk about the records that were set during the April, May, June recovery. And as we know, this recovery was also the strongest on record. Here's a chart of the S&P. And actually, the NASDAQ over that same time period, the NASDAQ only took it till June 8th to get back to all-time highs. The S&P, after bottoming on March 23rd, took less than 5 months for the S&P to rise to a fresh closing high. And the NASDAQ, even better, has actually had over 3 dozen record closes so far in 2020. I mean, to hear that over 30 new record highs in a year, that's arguably one of the craziest on record, especially when we're talking about drawdowns, is pretty remarkable. And in fact, the S&P recovered to new highs in just 126 trading days, the fastest such recovery on record. On average, the Dow Jones takes about 1,400 trading days to make a new high after falling into a bear market. So again, if you want to call this a bear market, different people have different definitions for that. Some stick with, the economic, that there needs to be an economic recession to go along with it. Some people stick with the standard 20% drawdown. However you want to look at it, one of the quickest recoveries back to an all-time high. In fact, in less than 1/10 of the time that we would normally see following a bear market. And when looking at quarterly returns, Q1, worst quarter on record, down 20%. Bounced right back in Q2, up 20%. So again, huge swings there in the first half of the year. And as you can see, since then, we've moved on to record highs. But, at the depths of the bottom there in March, no one probably figured that this is where we would be at, looking to close out the calendar year here in December. Circuit breakers. Circuit breakers are something that definitely got a lot of tension during March. We saw circuit breakers on the 9th, the 12th, and the 16th to the downside. I believe there was one more to the upside in there, and that might have been on the 13th. Is that the 13th or the 15th? I can't quite remember. I think there is one to the upside, but then we got another one that very following day to the downside again. And I believe we also had a circuit breaker recently here in November, upside 7% for the Russell 2000. But those 3 circuit breakers over, in just an 8-day span, something pretty crazy that I don't think a lot of people will forget. Stepping away from stocks, let's talk about crude oil. And something I don't think anyone ever really thought was possible. On April 20th, crude oil futures hit a mid-session low below $40. I honestly didn't even know that this was possible. I guess everything's theoretically possible, but negative $40 oil. And we bounced right back and have continued upwards since, now sitting at over $46 a barrel. But what a crazy day. Certainly something that will stick with me for years and years to come. Another area that's gotten a lot of attention so far in 2020 is the gap between growth and value has gotten really, really extreme. In fact, I would say it's probably the biggest since 2001, but in many ways even kind of puts that to shame. So between late February and late May, about 57 trading days, large cap growth outperformed small cap value by 44%. And that's a lot. And that's a lot, especially over 57 trading days. So maybe about 2.5 months there. Really, when we talk about, open market sessions. Well, let's look back at 2001. Between late January 2001 and September, about 164 trading days. So almost 3 times as many trading days. Small cap value outperformed large cap growth by 45%. So similar amount of performance spread, but in 2020, this occurred in about 1/3 of the time. So huge dispersion, both during the drawdown and on the subsequent rally. Very, very interesting. Another way to look at this, if we're going to take the best performing and worst performing sectors, tech and energy, between February 27th and November 6th, 181 trading days. tech outperformed energy by over 130%. Again, let's go back to that dot-com bubble, the unraveling of it from the March 2000 peak to April 10th in 2001. So 13 months later, about 263 trading days, energy outperformed by 68%. So, not quite as twice as much as many trading days, but significantly bigger spread than even what we saw back then after tech was getting absolutely crushed. The complete opposite happened in 2020, and even to a faster degree. Another thing that's gotten a lot of attention in 2020 has been the put call ratio, especially here recently. As we can see on a daily time frame, it is down to a pretty historic low, not quite as low as we saw in 2010, but certainly down to where we saw in 2004, 2006. And so looking at that, it might not seem too bad, but if we want to zoom out and look at the put call ratio on a monthly close, by far the lowest it's ever been. It's clear when looking at the monthly close, and certainly something to keep an eye on going forward. I think recently one of the biggest extremes we've seen is actually the upward movement we had in November. Using the Russell 2000, specifically its best month on record, 8+18%. Kind of ironic given it's the worst performing index of the year, although has been a leader off the lows, up there with the NASDAQ. They've kind of traded places. It has been strong off the lows. And also the best month ever for the MSCI ACWI, up 12% in November. And what I think is so interesting is that these price thrusts are happening actually at all-time highs and not all-time lows. I think it would be typical to see something like this happen in a March or, March 2020 or a March 2009 and April 2009. But we're actually seeing them in uptrends. So certainly different behavior there. One last thing that has gotten a lot of attention, and some people think it's extreme. People like me might think it's just how the law of large numbers works. But Apple was the first company to hit $2 trillion in market cap this year. I think that's pretty impressive. Obviously, at some point, we had the first company that was ever $1 billion or $2 billion, the first company to ever have $1 billion in market cap. And I assume one day we'll have probably a company that hits $1 quadrillion in market cap. That's just the way the market works. I don't think it's too crazy. So kudos to Apple. Has been a very strong stock and obviously been rewarded as, the largest company in the world. Last but not least, I would like to say that if you are a market participant, I don't care how young you are to the game, or if it's 2020 was your introduction, or if you've been an investor, a market participant, a trader, in any aspect for sell side, buy side, for any aspect for decades. 2020 definitely had some extremes that I don't think anyone could have predicted or prepared for. And if you are here, if you survived and you're going to keep playing the game, then I say kudos to you. Congratulations. Stick it out. 2020 was a great learning experience for everyone involved. And I wish you the best of luck. And let's hope that 2021 doesn't have nearly the amount of extremes or volatility that we saw in 2020.
Hey, Grayson Rhodes here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.